Good afternoon, ladies and gentlemen. The time is 12:20 and today is the 21st of March. I exited my position around 11:50 and I'll go over exactly what the trade was. I'm traveling, so I'll be in Qatar, Doha for the next 1 month. And so the day for me starts actually at 6 o'clock now because market opening time as per the time here is at 6:45. So it's an early day, and for a Monday, I think I'm more or less happy with how things played out. And I will go into exactly what the trade is. My view went completely a little bit off, but regardless, I think the environment was good enough, and the premiums also were good enough. Wherein even if your view was off by a little bit, it was okay if you were doing a strangle because the premiums actually were quite good. In fact, the net fall off when you look at 500, 600 point strangles and beyond between Thursday close to today is between 10 to 20%, depending on how far you are. And that is a very, very, very good and attractive kind of premium on a Monday to trade, especially given all the other factors. So first of all, Friday was an excellent day for the US markets. We had S&P 500 and NASDAQ closing almost 1% up. Sorry, NASDAQ closed 2% up, S&P 500 and Dow Jones close to 1% up. And in that sentiment, SGX Nifty was also trading at 17,500. And as on Friday, the indication to people would have been that there's a good chance we open at 17,500 today. This morning, there was a little bit of negativity coming in from the fact that futures opened in the negative, and based off that, we were still looking at a 100-point gap up. But we ended up opening quite flat. So we opened at 17,500 itself. Now here my thought process is basically what I put in my tweet in the morning. Like I'm going to take a bullish bias because the market right now short term looks bullish, and of course because premiums are still quite high, and as you know, strangle is a relatively bullish strategy because it is short IV, and generally short IV means it is bullish even though it is sideways. Anyway, so I entered a position where I wanted a little bit more premium on my put side. Then this is where we opened. Wanted a little bit more premium on my put side than my call side. So I shorted the 17,700 call for 51.5 and the 16,900 put for what I wanted was 60. I mean, the price at which I punched the order was 60. But by the time my order executed, obviously in the morning it's difficult to get those prices. My order executed, I got a price of 57 on the put and 50 on the call. So not so great, but still all right. And I think the only time my mark to market was negative was in probably the first 2 minutes after entry. And max negative it went to was like 2 points negative. And through all this, now once we headed back here my position was actually already in a 5-point profit. So the profit that I booked more or less is the same profit that I was sitting on at 930. From here, we had this steady down move, and my idea was that I do not want to adjust for the call side. The thing is, into this down move, the behavior of options is that yes, puts were gaining, but calls were giving up a lot more. Even though I entered with a position where I have 60 rupees on my put side and 50 rupees on my call side, into the down move, I was actually making a profit. I was in green this entire time. And my idea for the put option, the reason I didn't want to bring down my calls is the calls are losing so much into a down move. Now, if I bring down my calls at this depreciated value, in case there's like an up move with now an IV spike on the call side, then I will lose a lot more on those calls. So my preferred approach was to have a stop loss on the put option. Now, that was during this phase, which is basically Thursday closing high. And you would think that it got triggered here, but by then, if you see, my stop loss was already moved on a mark-to-market basis. So currently, even at that point, when that particular high was broken, I was still in a profit, and the risk to reward looked good for me because I still felt that 17,200 will act as a very good support, and there's no reason to either bring down my call, which will backfire immensely in case now there's a point where we take out the day's high. It will backfire immensely. And secondly, I have a stop loss on this position. So worst case, I lose 20,000. No problem. Look, today's a Monday. I'm not exactly trading for large targets or large this thing, and I'm not willing to take a large stop loss. 20,000 stop loss was what I had on the table. And more or less the trade worked out. It went into a good green. At one point the trade was in like 1.8 lakhs profit. I was trailing a stop loss of 3 points. The thing is, in this volatile market, you have to keep a little bit more of a larger risk appetite also. So 3 points was a little bit larger of a risk appetite. It hit and I exited my position. I in fact overbought it a little bit here and squared it off. Didn't really cause too much harm from doing that. So that was it. Basically, I took a triangle position. It went against the direction I would have liked. I would have liked it if it held around 17,300, 17,350. Regardless, there was good enough premium in the morning that despite the move being against me, the position was in green. And I had to trail profits at some point. Today's a Monday. I can't exactly like let the trade play out the entire day, because if we do break here, so if we do break the day's low, then and we break 17,200, then there's going to be a big amount of covering on the put side, and that is going to spike them. So basically, I didn't like to have a neutral or slightly bearish delta on my position. I just didn't like that. And secondly, if I don't get rid of my slightly bullish position, because I'll be short 72 rupees put option and 30 rupees call option. If it goes against me, it will hurt me a lot. So just not attractive. Yeah, that's about it. So this is more or less how your thought process needs to go. Okay, what kind of view do you want to create? What is the risk reward in that view? How long can you hold it? If that risk is met, if you have a relatively lower risk that you've set, then it's best to get out at when that risk is hit. And it's also good to trail. I mean, even if you go wrong, you can still book some profit if you trail appropriately. If you say, the position is going to come back in my favor, it sometimes can be too far gone for them to be able to deal with that. Thank you so much for watching, and I will catch you later. Take care. Have a good one. Bye bye.